Hello everybody and welcome to our Q2 2019 investment vodcast. We'll start by discussing performance of major asset classes over the quarter, followed by some of the key macroeconomic and political events. Looking at the asset class returns generated over the quarter, it is clear that global markets overall performed quite well. This does, however, mask the volatility present in markets over what was a very mixed quarter. Despite the ongoing trade war between the United States and China, as well as deteriorating economic data, dovish statements from the Federal Reserve indicating that further interest rate rises in the US were unlikely, buoyed investors, and equities reacted favourably to this. In contrast, Japanese equities underperformed as the earnings of Japanese companies were negatively impacted by the strengthening yen. Corporate debt, both investment grade and high yield, also benefited from this continued improvement in sentiment, which when coupled with interest rate expectations generated good returns. This also fed through to government bonds, which saw increased demand. Within the UK specifically, weaker GDP growth and the ongoing Brexit-related uncertainty increased demand for government debt. Whilst overall I think it's fair to say it was a positive quarter for most major asset classes, the heightened volatility should not be overlooked. If we now move on to look into some of the key macroeconomic and political events over the quarter. Globally, growth has generally slowed, which is disappointing, more notably in the UK and Europe relative to the US. In contrast, unemployment continued to fall across regions. Within the UK, PMI survey data suggests GDP growth continued to slow over the quarter, driven by a slump in business investment caused by the ongoing uncertainty around the UK's post-Brexit trading arrangements. This uncertainty saw Q1 GDP growth jump as a result of stockpiling ahead of the original 30th of March Brexit Day. Unemployment declined to multi-decade lows in April, while inflation also declined. Brexit remains a principal concern for investors. A further extension of the Article 50 negotiating period saw the UK hold EU Parliament elections in May. Whilst Nigel Farage's fledgling Brexit party came top, the anti-Brexit Liberal Democrats also performed strongly, beating both the Labour Party and the Conservatives. The resignation of Theresa May kicked off a Conservative Party leadership campaign, which saw a field of 11 candidates whittled down to 2, Jeremy Hunt, the current Foreign Secretary, and Boris Johnson, with both emphasising that they would be prepared to crash the UK out of the EU in October. Moving across to the US, the expansionary effects of President Trump's tax reform have now fully subsided, and the cooling effects of the ongoing trade dispute with China are being increasingly felt. Despite a weak jobs report in May, which followed downwardly revised figures for both March and April, the unemployment rate continued to decline, hitting multi-decade lows. Dovish comments from the Federal Reserve, as well as the ongoing attacks by President Trump, have seen interest rate expectations decline. In fact, the markets are now forecasting an interest rate cut in the US, maybe as soon as this month. Trade negotiations with the Chinese authorities are ongoing, despite an escalation in tensions. In May, tariffs were raised from 10% to 25% on $200 billion worth of Chinese goods. China retaliated by imposing tariffs on $60 billion worth of US goods. However, during the recent G20 summit in Japan, President Trump announced that a truce had been agreed, which would prevent any additional trade restrictions being imposed. Could this lead to something more substantial? Export-sensitive economies have borne the brunt of the ongoing trade tensions, which has hurt Europe considerably. In light of the softer GDP figures and the continued lack of inflationary pressures, Mario Draghi announced a further round of target long-term refinancing operations, which seek to provide long-term loans to banks, offering them an incentive to boost lending into the wider economy and stimulating demand as a result. Dovish comments from the European Central Bank that further monetary accommodation could be added also encouraged markets, as did the nomination of IMF Managing Director Christine Lagarde as Mario Draghi's replacement. She is seen as a continuity candidate and much preferred to a hawk like the current Bundesbank President Jens Weidmann. The EU parliamentary elections in May saw the hard right populist parties underperform expectations. Whilst the mainstream Conservatives and Social Democrats were the two largest groups, the Liberals and the Greens greatly increased their representation in a parliament that maintained its pro-EU majority. Within the emerging markets, as with all other regions, Chinese GDP growth also slowed, albeit only marginally. Weaker domestic demand, as well as the negative impact from the ongoing trade dispute with the US, saw the government downgrade its growth forecast for 2019. In light of the weaker growth figures, the People's Bank of China cut reserve requirements in the banking sector further in order to stimulate the economy by increasing the funds available to banks to lend. Narendra Modi was returned as Prime Minister of India after a landslide election win which saw his National Democratic Alliance win 353 seats in the Lok Sabha. He is likely to cut taxes and embark on a massive infrastructure programme to boost GDP growth, which had slowed during Q1. Although trade tensions have exacerbated over the quarter, there's hope of potential truce between the US and China announced at the recent G20 summit may lead to something more substantial. So that leads us nicely onto our outlook. Looking forwards, the second half of 2019 is likely to see global growth remain subdued, although consensus appears to suggest a recession is unlikely, with additional fiscal stimulus and looser monetary policy expected. A trade deal between the US and China will provide a boost to the global economy and wider capital markets should a deal be reached. However, continued Brexit uncertainty will see heightened volatility, which is likely to extend well into the second half of 2019. I hope this has been a helpful overview of the macroeconomic backdrop and markets over Q2. I'd like to thank you all for listening, and I look forward to recording our next podcast in October.